Here in this video too, we'll do more writing here, which is more like the advanced accounting in the SBR. Now, in the exam, we could take role as a parent, as an investor, or as an operator or venturer, depending on our involvement in the investee. If we control the investee, then we are the parent, where the investee is our subsidiary. If we exercise significant influence in the investee, then the investee is our associate and we become the investor. If we have joint control over the joint arrangement, so we will be then the operator if this is joint operation, or venturer if this is a joint venture. Let's revisit control again to look at the definition in greater detail, because you will be needing this in the advanced accounting. If you can control, that means you have power. But power alone is not enough to satisfy the definition of control. You also need to exercise your power to get a variable return, where the variable return can consist of positive return or negative return. Power, as we can see in the middle box here, current ability to direct. Power can come from voting rights if you have more than 50% holding. If you don't have 50% holding, let's say you only have 45 or 48, but you have convertible loan stock in your hand, or you have share option in your hand, where after you exercise this, you can get more than half, then that will also be counted in by arguing that you have the power. Rights to appoint the key personnel, which you can have the power to appoint the director. Decision rights within a management contract, so the company could appoint you to run the management, functions. Okay, so that could also be a power to you. Or removal or kick out rights to remove directors. Okay, so power can come from different sources, like as illustrated just now: voting rights, potential voting rights, appointment, management contract, and even removal. You must exercise power on the relevant activity of the investee in order for you to prove that you have control. Relevant activity are those significantly affects the return of the investee. Example: determine the operating policy, to set directions, making capital decisions, sources, where do you get money, investment, where do you place your money. Appointing the management personnel is also one relevant activity that can significantly affect the return of the investee. And the management of underlying investment, which is the most important investment, which will also significantly affect the return of the investee. If you have control, you must be able to use your power to direct the relevant activity so that you can get variable return. Is exposed or has rights to variable return. Return can be positive or negative or both. That's why we say it's variable. Example: dividend, which is available to all the investor, not just the parent. NCI can also get dividend. Remunerations, which implies only to the parent, because parent manage, so parent will demand for payment. Or return not available to other interest holder, it's only for parent. Economies of scale, cost saving, scarce resources, knowledge, synergy. Those are also return, being an intangible return. Next page contains a diagram to summarize the steps to decide whether you have control or not. First, you identify the investee. Identify your subsidiary. The investee could be a legal entity, which means the whole entity, or silo, which is part of entity. Sometimes we do not control one company, we control only one department of the company. So under the modern accounting standard, even if we control only part of the subsidiary, that part of the subsidiary will also be qualified as business combination. So subsidiary need not to be whole entity under the modern accounting. Subsidiary can also be part of the entity. Identifying the relevant activity of the investee, which we have just discussed some example just now, deciding the operating policy, deciding the capital and all this. Identify how decisions about relevant activity are made. Are we able to participate? And assess whether we have power. Where do we get our power? Consider only the substantive rights. Substantive means reality. The reality is voting rights are relevant or other rights are relevant. Sometimes if you look at the rights and the other rights here, we do not hold shares. We don't even have 1% in the subsidiary, but in reality we are having power. We'll discuss about that shortly. Now let's look at the left side. Consider only the reality on the left side where the voting rights are relevant. Yeah, most of the time, in order for you to control a subsidiary, most of the time again, you have to buy shares. And most of the time, you need to own more than half of the total, then you can have power. If you have majority voting rights, then you are very close to control already, but then please consider rights held by others. Can other people challenge you even if you have more than half? Can other people remove your director even if you have more than half? If no, then you are the parent. If yes, the other party might be the parent. So where voting rights are relevant, if you have majority voting rights, you are very close to control, but please consider rights held by others. If you have less than a majority, less than half, please don't give up. Check, do you have agreement with other vote holders? If you only have 45%, do you have agreement with other shareholder to combine votes so that you can get more than half? Consider other contractual arrangement. Let's say, for example, management contract. Yeah, you have less than half of the voting rights, but do you have a management contract where you can get control? Potential voting rights, you have only 45, but do you have convertible loan stock or share option available? Consider the de facto power. Okay, power in fact. For example, kick out rights. Do you have the kick out rights? Okay, that is where the voting rights are relevant if you have more than half and if you have less than half. Other rights are relevant. That means set up special purpose vehicle or special purpose entity, SPV or SPE, that means the same thing. Now in the special purpose entity or special purpose vehicle, the owner of the entity will set up the entity as a new company but does not own shares in the company. Instead, the owner will appoint nominees to hold shares in the company. Now this will make sure no one knows that the owner is behind all this picture. But in order to prove that the owner has the control, we still have to trace back what is the purpose of this company being set up. which is now a subsidiary to the owner. And how is the design? The purpose could be just to serve back the owner, and the design is the nominee are taking instruction from the owner. Evidence of practical ability to direct. For example, owners, not shareholder. Give instruction to shareholder. So that is the evidence of practical ability to direct. You are not the shareholder, but you can instruct the shareholder. Special relationship, like for example, loan guarantor. You are not the shareholder, you are not the director, but you are willing to guarantee their loan application. Exposure to variability of return, get benefit, and cover losses. A special purpose entity is not easy to identify. We need the honesty of the management, of the parent of course, and the honesty of the accountant of the parent to proactively identify the special purpose entity, run through the task to see whether there's any control inside, and to consolidate the special purpose entity. We discussed the significant inference in quite a detailed extent in the first video, Basic Console 1. Now we look at Basic Console 2. We focus more on control and joint control. Joint control looks very similar, except that in controlling interest control, we only have one parent, but in the joint control, we have more than one so-called parent, but then we call them joint operator or joint venturer, joint operator or joint venturer if we have more than one parent. Joint control is contractually agreed, so you need to have contract. Contractually agreed to share control is same as the IFRS 10, same as a subsidiary, which we have power, variable return. It was discussed just now. Contractually agreed to share control of an arrangement about the relevant activities which require unanimous consent of the party sharing control. Unanimous means together. We need to agree together. So let's check scenario number 1 and scenario number 2. Look at scenario number 2. No contractual arrangement exists to share control. Automatically, if you look at scenario number 2, there's a cross here. Scenario number 1, A and B has contractual arrangement to share control. Scenario number 1, A have 50% holding, B have 30%, C have 30%. Does collective control exist? Collective means together. Yes, we have. A can join forces with B to control, get 80%. A can join forces with C to control to have 70%. B cannot join forces with C to control because they only have half. So A and B can, A and C also can. There's a collective control. But does joint control exist? Joint control, you need to have a contract. And in scenario number 1, yes, we have joint control because A and B has contract. If B and C sign contract, that is no then for joint control, because even if they have a contract, B and C cannot have more than half. So scenario number 1, yes, we have joint control and this is a joint arrangement. Scenario number 2, do we have collective control? Yes, we have. A and B can join together, A or C can join together as well, B and C cannot join together. But do we have joint control? No, don't have, because there's no contract to lock in any party. A sometimes can cooperate with B, A sometimes can cooperate with C, B sometimes incorporate C, so we don't have a joint control. So this shows the importance of the contract, that we need to have a contract to lock in to fix the party cooperations. Difference between joint operation and joint venture. We will ask ourselves a few questions to decide whether it's a joint operation or joint venture, and we have to do that because the accounting will be different. Joint venture is a separate legal entity. Whereas in joint operation, there is no separate legal entity. If it is a joint venture, it will follow the associate accounting. If it is a joint operation, we'll look at the example later. Whereas the associate accounting, we already discussed it in the video number 1. So now we look at this diagram to decide whether that something, the joint arrangement, is a joint operation or joint venture. Looking at the diagram, I have a feeling is that it is easier to prove that it is a joint operation because every question has an escape. But it is not easy to prove that something is a joint venture, which you need to go through all these questions. First question, is the joint arrangement structured through a separate vehicle, which is a separate entity then? Separate entity. As I say, joint venture is a separate legal entity. That's why the first question is, do you have a separate entity? If you say yes, then we may continue the journey that works towards the joint venture. If you say no, then of course it will be joint operation, because you don't even have a separate entity at the first place. It will be automatically a joint operation. If you have a separate vehicle, then does the legal form of the separate vehicle give party rights to the asset and obligation for the liability? So the party rights in a separate legal entity, the parties to the contract cannot have the rights to the asset. If you say yes, then there's no separate legal entity. Obligation for the liability. If you say yes, then there's no separate legal entity. If you say yes, then there's a joint operation. If you say no, the legal form does not give rights to the party on the asset and obligation for liability. So that implies it's a separate legal entity. Then we go down to the third question. Does the term of the contractual arrangement give party rights to the asset and obligation for the liability relating to arrangement? So that means we sign contract, this one, to convert a company to partnership. Sometime in doing certain businesses, the country law will require the registration of a company, although the parties to contract want to register a partnership, but the country law requires company, for example. So legal form is a company, which is a separate legal entity. But if the partner wants to run it still like a partnership, they will sign contracts separately after forming the company. Sign a contract that everybody agreed we were going to manage the company like a partnership. So if you say yes, we have such contract exists to convert a company to a partnership, it is still a joint operation, because still in reality there is no separate legal entity. If you say no, we don't have such contract, then we ask the last question. Does other facts and circumstances give party rights to the asset and obligation for the liability relating to the arrangement? So these so-called other facts and circumstances, just to see, is there any other evidence that they want to convert the company to the partnership? If you say yes, there are certain evidences, to show that they want to run like a partnership, then it is a joint operation. If still no, then very confirm the parties want to run it as a separate vehicle. That is a joint venture, where the accounting will be following the associate accounting. Regarding the joint operation accounting, we haven't discussed this in any video whatsoever before this. Now we are seeing this for the first time. And this example will end our basic console video number 2. And after this, you will follow by a few questions, which focusing mainly on writing to see how we apply these consolidations in advanced accounting. Accounting for joint operations. Robbie has 40% share of an operation. So Robbie is a joint operator. It's not a joint venturer. It's a joint operator. A natural gas station. So this is a petrol station. Assets, liability, revenue, and costs are apportioned on the basis of shareholding, which Robbie will be sharing 40% for all the asset, liability, revenue, and costs. The following info relates to the joint arrangement. The petrol station cost $15 million to construct, which Robbie has to share 60% to it, and was completed on 1st June 2011. 1st June 2011, year end is 31st May 2012. Alright, so this is the year start, and it should be dismantled at the end of its life of 10 years. Present value of this dismantling cost to the joint arrangement at the beginning of the year, using a discount rate of 5%, was $2 million present value. So this will be capitalized, provision for dismantling cost. It will be capitalized together with the petrol station. In the year, gas with direct cost, which is petrol with direct cost of sales of $16 million, was sold for a sales of $20 million. Additionally, the joint arrangement incurred operating costs of $0.5 million, which are other expenses, during the year. So Robbie, being a joint operator, will be sharing cost of sales, operating costs, everything at $0.5 million. Robbie has only contributed and accounted for its share of construction costs, paying $6 million. Yeah, I think that is the figure. If you use construction costs of 15, 40%, yes, 6 million. So Robbie only accounted for the 6 million. Revenue and costs are receivable and payable by other joint operator who settled the amount outstanding with Robbie after the year end. So we didn't actually receive nor we pay any cash other than the 6 million regarding sales and cost of sales. So we recognize receivable and also the payable. Right, what happened here is you have quite a good space here at this page 4, so which we can just draw a line here. Right, so draw a line here. On the left, we have asset, equal size, liability, so you still have space at the bottom. Income, equal size. Expenses, we still have some space at the bottom. So we have 4 things to share from this joint operation: asset, liability, income, and expenses. Okay, I'm going to use my Excel to do this. Asset, liability, income, expenses. So the gas station is a PPE, which construction cost of 15 plus a provision of 2 million, and Robbie will share 40% to this. Okay, I believe you have some decimal places to fulfill. Let's get it ready. I get 2 places ready. Depreciation, 6.8, 10 years. So the yen carrying amount of the asset will be 6.12 after charging a depreciation based on 10 years. Based on the question, 40% of 6 million has been paid. The 2 million, they haven't do accounting because the 6 million is the only accounting entry they have. And this one will debit the asset and credit to the provision. That is the 0.8. This is the present value at the start of the year. When come to yen, we have an unwinding interest to calculate based on 0.8 times a discount rate of 5%. Okay, so the provision will be getting higher by 0.04. The depreciation is an expense, and the unwinding interest is the finance cost. Okay, so we settle the gas station, depreciation, provision, together with the unwinding interest. Then we have the sales, which is a revenue. Cost of sales. Operating costs. We didn't receive cash regarding this amount. We didn't pay cash regarding this amount because the settlement is temporarily done by another operator. We will discuss about the payment and receipts with this operator after the year end, isn't it? Let's check the questions again. We're going to settle the outstanding amount after the year end. So to the income here, we have receivable, okay, debit, credit, and here we have a payable. Two figures together, settlement after the year end. Okay, the receivable and the payable are with the same person, same operator. But without any further detail, I try not to offset them. I try not to contra them because maybe the credit period is different, or maybe they don't have the intention to do the offset or whatever. So it's better to keep them separate if there's not enough information for the offset. Right, so that's all on how we consolidate the joint operations. If we do consolidations, the console account asset will be increased by 6.12, receivable increased by 8, liability, income, expenses will also be increased accordingly. And you please do not worry about if the account not balanced. No, there's no problem because we observe very close double entry here. Debit, credit, debit, credit, debit, credit, debit, credit, and everything is by double entry. Right, so that is the end of the video 2. Coming up next, we have a few questions which are mostly writing theory questions.